Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. It's been a few weeks since I've made a video, but it's been an interesting week indeed. We've had a lot of turbulence in the market. Inflation has finally become enough of a problem that the Fed has signaled the need to raise rates a couple of times, and the market has reacted poorly to that. Whether it's the stock market or the crypto market, you can see 130 billion wipe off the crypto market. Any growth slash speculative investments have been punished a ton. The valuations have come down a ton in a matter of weeks. Gains that have been afforded over a matter of months and years have been erased in a matter of weeks. That's how quickly the market moves. Essentially, the market is looking at the future as more murky because the unknown of rates is coming. So if we look at the QQQ year to date, down 12%, but remember, when in doubt, zoom out, QQQ being a proxy for the NASDAQ. So down 12% year to date, down almost 2% pre-market. But if you zoom out a year, investors are still up 7%. If you zoom up 5 years, and even from the pre-pandemic times, huge gains since then. Certainly a lot of the stocks in the NASDAQ have benefited a bit from the pandemic, but we're still in a good position if you've been a long-term investor. If you were buying right here near the top, especially some of the riskier speculative growth names that have seen their earnings slow down, you're being punished severely right now, but that's something you have to keep in mind when investing in some of these names. I've talked about the very high price to sales ratios in previous videos, whether it's about SPACs, whether it's about my portfolio updates. SPACs have been absolutely killed. These SPACs have been absolutely killed simply because they are speculative names with unknown growth rates in the future. And as yields come up, as the prospect of yields coming up goes into the market forward pricing, those get really punished because people look at those yields and say maybe those will be a little bit more interesting in the future. And you can kind of see that in the Russell year to date, down 12.5%, 1 year out, down 8%. If you go to the 5 years, still a decent deal up from where they were in the pre-pandemic times, but again, not a huge gain like with the NASDAQ. S&P 500 year to date, down 8%, still a year out, up 14%, and up quite a bit from where the pre-pandemic times had it. So what's causing this? Well, one, valuations, right? If you look at the Shiller P ratio, even after the recent downturn, still at a 36 against a mean of 16x. So that means a 3% yield against a 5.5% yield-ish, something like that. Shiller P might not be as useful here simply because it's got the really crappy pandemic earnings in there, so that's going to skew it up. But if you look at the P ratio, even after the reduction here and the growth in earnings since the pandemic started at a 25x, 15x mean, really you have to compare this against something, and the comparison here would be the 10-year treasury. At a 25x, you're still getting a, 4% yield. Earnings yield with potential for growth if there is growth in the future. If the growth becomes more murky because of rising yields, because of some geopolitical issues, because of inflation, because of issues with the supply chain, then this becomes at risk because there's a risk-free rate that's rising on the other end. Geopolitical, I mean, hey, maybe there's going to be a war between Russia and the Ukraine that's going to cause havoc and impact the worldwide economies potentially. Maybe inflation will become a bigger and bigger issue and the Fed can control it. That is a risk that's out there in the future. Maybe rates will rise a bunch to control inflation, and that'll impact the rates at which companies can borrow money and make growth harder to come by. So these earnings yield will come down. Realistically, though, a 4% earnings yield is certainly better than the 3.3% or whatever you were getting before. And if you compare that against the 10-year treasury rate, which is currently at 1.75, that's a solid deal, assuming that earnings will continue to grow, right? If you look at where these guys were in the 2000s, somewhere in the 40x range, that's maybe a 2.5% yield. The 10-year treasury rate at that time was in the 5% range. So the risk on, risk off trade-off, which is a lot easier to make. If I want to get off the risk of a 40x multiple, I can go into 10-year treasury that's yielding 5%. Right now, if I want to get off the risk of a 25x multiple, a 4% yield, I can get into a 10-year treasury that's yielding 1.75%. That's not amazing. Now, the calculus you have to make is that rate going to rise in the near term as the Fed raises rates maybe 3 to 4 times in 2022, maybe another 3 to 4 times in 2023? Will that make the 10-year rate closer to 2.5%, closer to 3.5%? How will earnings be impacted by that? Where will the stock market go? Is it better to be in cash right now? That's really what the market is trying to digest. If the Fed comes out a couple of weeks from now and says, hey, we're not going to raise rates as much as we thought we will, the stock market will shoot up. If the Fed comes out and says, yeah, we're doing it how we said we're doing it, inflation is still a big problem, the stock market could continue to be pushed down as people try to look for safer havens, which in this case would be 10-year rates that are rising, potentially cash even. I certainly have some cash at the time. And that's really why the stock market is doing what it's doing, is digesting a lot of this info, looking at some of these valuations and saying, holy crap, we were valuing this at what? If you look at something like, well, I don't want to look at Roku, but Peloton's been in the news. We can look at Roku as well. If you look at their valuations, they went up to 10x from a pre-pandemic valuation of 3x. They really saw growth that spiked that number. If you look at their trailing multiples at 18x over here, if you look at their EBITDA valuations 400x, they were not making any money. The idea was that now that growth is spiking, and if you look at the financials, the growth was certainly there. Now that growth is spiking, maybe these guys will make money if the growth continues that way into the future, which is always the assumption. But the reality is now the growth just isn't there anymore. It went from 120% to 5%. There's no free cash flow. The potential of free cash flow just isn't there. Even by 2024, they're looking at 138 million in free cash flow against 9 billion valuation. So if you look at that, the yield is 1.4% based on 2024 gain. So you're saying, well, maybe in 2024 my cash flow yield will be 1.4%. That's not very enticing anymore, right? You're looking at it even at today's prices, and this is after it has fallen 82% in the space of a year. That's a huge fall. So is this that enticing of an investment? Well, if you think growth is going to pick up and these estimates are a bit too low, maybe. But right now you're buying something that, based on the estimates, is going to get you maybe 4% in yield by 2026. That's okay, but not amazing. Right now, the S&P 500 on a free cash flow basis is maybe in that 2.5% range, and that's going to grow. So are you going to take 2.5% over basically nothing and maybe 1.5% in 2024, or is it safer to be in the S&P 500? I think it's safer to be in the S&P 500. And you can make a similar calculus in a lot of these growth names, which is why companies like Roku, which has seen their valuation fall 64%, is seeing a similar thing, right? You're looking at multiples that were in that 20x sales range on a forward basis down to 5x now, and you can do a similar calculus on these guys. It's like, well, what am I getting on a free cash flow basis? And I actually like Roku because I think it's still going to continue to grow. I like their product, but at the end of the day, it's a $19 billion company getting you 1.7% in yield, which is better than Peloton, but it's still not amazing. And was that based on 2021? Yeah. So if you go forward out to 2025, if they can achieve their estimates here, it's up to 7%. So that's a lot better, right? If you look at, well, right now I'm getting 1.7% versus nothing on Peloton. 5 years from now, I might be getting 7.3% versus maybe 4% on Peloton. If all things go as planned, Roku is a better investment than Peloton, in my opinion, right? Again, this is for entertainment purposes only. I'm not a qualified financial advisor. Please do your own diligence to talk to a qualified financial advisor. But as I look at some of these stocks, this is the kind of math I'm doing in my head. Well, what am I getting now? Is this a company that is free cash flow positive today, meaning they probably don't have to issue shares to grow, meaning they can probably weather some, higher rates. They don't have to take on a ton of debt to grow. They can maybe achieve these numbers without that happening. Is their current demand showing that they can potentially achieve what their estimates are showing here? In the case of Peloton, probably not. In the case of Roku, maybe. Obviously, things can change on a dime. Maybe 5 months from now, there's another strain of the pandemic that keeps us inside, and we're all getting Pelotons and we're all getting Roku players, and both of these stocks are doing really well. But right now, the calculations have switched into the other direction. Now you're looking at these stocks and you're saying, well, the rates are rising. It's going to be harder for these companies to potentially grow as we come out of the pandemic, because these are all, sort of pandemic beneficiaries. Their cash flow right now is already negative. I can get more cash flow in an S&P 500 or a more stable stock or a value stock that is valued at a much lower multiple, and the risk emphasis has changed to be risk off versus risk on as it was before. That's why a lot of these growth names have been punished, and why a lot of these valuations have just dropped off a cliff, right? If you were buying this at 19x just 6 months ago, you're pretty pissed off that now you can buy it at 5x. However, if you like the company, you're kind of happy that now you can buy this at a 1.6, 1.7% cash flow yield versus 0.2% here, and a 5x multiple versus a 19x multiple. What's really changed, right? It hasn't really been that Roku is suddenly a crap company. It's just that the valuation metrics have really changed, and the market values certain things differently. It's not valuing this high growth names as it has in the past. And again, these 19x multiples were crazy to begin with. I talked about this before. You never really hit those before the pandemic, right? At best, you're at 11x. But now that you're down to 5x, this is almost the best time to buy Roku since basically 2018, when it was growing at a much smaller clip and it was a much smaller company. So now it's actually free cash flow positive. It's growing. It's changed its business model to be more advertising based, to be more even having its own channel base, etc. And potentially the company is a lot better buy now than it was back then, and the valuation is the same. Similar things happen to another company like C Limited. You look at their valuation, and this is an e-commerce / video game player that does business in Southeast Asia, and now it moved to South America. The multiple here is still kind of high on a price to sales basis. Whoops, this is 1221. It's actually a bit lower. Let me go back. So it's 5.9x. So it's kind of back to where it was before the pandemic. And the company is a much different company than it was back then. Well, in 2019, the growth was there, but it's grown even more since then and is now a bigger company on a free cash flow basis. This is still an $80 billion company for 2021. These guys are going to pull in only $433 million in cash flow. So the multiple's 0.5%. So not very good, but it is positive. And if you look at 2025 divided by 80, right, you're talking about 6.7%. And this is a company that I think is going to understate their free cash flow for a while, because they're pouring money into growth right now. They're expanding into South America. They're doing a lot of stuff. And there's a ton of companies like this where you can look at, well, what's happened in the past couple of months? Well, they've come down a ton. Year to date, these guys are down 36%. Valuations have come down to earth. They might still be high for certain companies. 18x is kind of back to where it was before the pandemic. But again, is this a really good company? Can you look at their cash flows? So these guys are even lower. These guys are 0.3%. And then you go forward, 2025, 2.8 billion against $100 billion market cap. That's a 2.8% yield. Is this an amazing valuation? But again, this is also a company that's pouring money into growth, and potentially they can grow at a faster clip. If they can't, then maybe Shopify's still overvalued, right? It's crazy to say that after a stock has fallen 50%, but if you just look at the financials, well, in 2025, these guys are going to cash flow yield what the S&P 500 is yielding right now. So why am I paying way more than the S&P 500 for it, right? I can get the S&P 500 for maybe 3x revenue. So I'm paying 18x revenue for this. when this is going to yield on a cash flow basis what the S&P 500 yields now by 2025 only. And again, these guys are pouring money into growth, so that free cash flow isn't all that reliable, and these are all estimates, so again, they're not all that reliable. But this is how I look at some of these valuations and why I decide to buy certain stocks. You can look at a similar thing with SPACs too. And again, these estimates are going to vary wildly, but you can see SPACs that were valued at a 15x multiple are now valued at a 3 to 4x multiple on a sales basis. And a lot of these aren't making any money right now, but you can look at this $1 billion company that I actually really like, GENI Sports Limited. They do, sports technology infrastructure, sports betting data, that sort of thing. They're the official provider of the NFL, although they gave up a lot to get that, so it's hard to tell whether or not they will pay off. But you've got a potential, based on the estimates, 5% cash flow yield in 2023 if they can hit this. Now, this is a question mark because they burned $100 million in cash in 2021. But if they can achieve that, pretty good deal. Sports Radar, which is a stock that I actually bought recently, another one that I will continue to watch as it falls because it's fallen basically 50% since it's IPO'd at a let's just show all. Yeah, it's fallen 50% since its IPO. So it IPO'd at like 26, 27, collected $800 million in cash, and has just fallen every day since then. But the valuation has gotten a lot more interesting now, down to a 4 to 5x multiple. And if you look at their financials, right, this is a $3.3 billion company with all the cash they have on the books. They're already free cash flow positive now. So I can get 3 to 4% free cash flow yield today on a company that's growing at a 20% clip and expanding their margins. And I think this is, again, optimistic. They just lost the NFL deal, so they have to make that up somehow. But I think this is a company that's already free cash flow positive, but that's already making money and is in the growth area and is in an interesting growth area, that being the sports betting and gambling space in the United States, which is just starting to grow, which is just starting to expand. Now, losing the NFL was a big hit, but like I said, GENI paid an arm and a leg for that deal, so it's hard to say whether it was a good or bad move by Sports Radar, but they have a lot of other leagues that they deal with. They have a lot of mission critical data software, and they're growing at a decent clip, and they don't have a lot of exposure to the United States, and that part of their business is growing at a massive clip, almost doubled in the last year, although it's a small part of their business. So interesting space. And as these stock prices continue to drop, if they continue to drop, I'm going to be ready to pick some of these up. And this is how I look at this stuff. So when you look at, hey, what's going on with the market, it's down 1.5% here, and it's probably going to continue to sell off until something happens, until there's some area of the market or area of risk that says maybe it's time to buy, right? And that's probably something from the Fed, probably needs something from inflation data that's better. Who knows when that's going to happen? But again, it's impossible to time the market. Most of my money is still in the market. I've lost a bunch of money in the last couple of weeks, just like most of everyone has. I do have some puts here and there that I take some profits off, build a cash position. I have a decent sized cash position, and I'm continuing to take advantage of the dips. I'm not buying all in, but I like I said, I bought a few shares of Sports Radar. I'll probably buy a bit more as it keeps falling. I'll start putting money back into my M1 Finance accounts soon because the growth valuations are starting to get interesting again in a lot of names. And they might keep falling in the next couple of weeks, in the next couple of months, who knows? But when I look at these valuations 5 years from now, do I think that 10-year treasury rates are suddenly going to be at 10% and make the stock market useless? No. I think these valuations, if I'm getting 4 to 5% cash flow yield today on some of these stocks, and I can probably get 7 to 10% a couple of years from now on some of these stocks based on today's prices, that's a lot more appealing than it was a couple of weeks ago, a couple of months ago, when these yields were probably 1 to 2% based on those prices, and future yields will probably 3 to 4% based on those prices. So again, if you look at PE ratios, still kind of elevated, 35x for the NASDAQ, 27x for the S&P 500, 590x for the Russell, a lot of negative earnings there. It's still the pandemic being in there. Future forward earnings, 23x, 23x, 20x respectively. These are kind of murky because sometimes they exclude negative earnings, which are kind of messy. So these are probably higher than what we're actually showing here. So are the P ratios suddenly amazing because of what's happened in the last couple of weeks? Not really. If we are going to see 3 to 4 rate raises this year and another 3 to 4 next year, is this correction warranted? Totally warranted. Might need to go on a bit longer for the valuations to be reset to where they should be if 10-year rates are in the 3, maybe even 4% range by that point. You certainly need this to be in a lower rate than it is right now. But we're getting to a point where, hey, buying is interesting. And what is an investor to do if they've been in the market and they have not sold at the top? Well, that's just investing. That's how it works, right? You're never going to time things perfectly. Sure, you could have sold here and bought back here. You would have had a tax bill here to pay and bought back at a lower number. That'd be fine. That'd be perfect. But you just can't time it perfectly. The market's going to eventually stop falling, is going to start rising again. And by the time you start, you get all upset about this 398 being where you bought, the market's going to be at a 450. It might take a year to get there. But if you don't need the money today, what's the problem, right? That's the idea of being a long-term investor. You put the money in the market that you'll need 5 to 10 years from now. And I think 5 to 10 years from now, the stock market's going to be way higher than it is today, especially on some of these names that are falling 80 to 90% in a matter of weeks. It's just a matter of seeing which ones are the right ones to buy and trying to focus on those ones. And that's a discussion for you and your investment advisor, or you and your own mind. The hard part of investing is exactly this. It's seeing that the stock market is falling. It's seeing that the gains you had on paper are starting to evaporate. But you have to remember, these gains, especially if you're buying here, are gains that are eclipsing the amount you had just a year or two ago. Even if you go back to 2020, just 2 years ago, you've probably gone up 50 to 60% since then, and easy come, easy go. So even if the stock market falls another 10 to 20%, you're still probably higher than you were in 2020. And yeah, the people that bought here on the way up, and I was certainly buying on the way up with my monthly investments into my 401k and my Roth IRA, but that's just the nature of the beast. That's just the stock market. It's going to move up and down, and the majority of the money is made in times like this. The best time to buy in recent memory was when the pandemic was hitting. The second best time to buy was during the 2008 recession, right? If you bought here, you're sitting pretty. And if this continues falling 20 to 30% more, let's hope it doesn't, but it might. Who the hell knows what's going to happen? What if another variant comes up? What if a war starts? What if something weird happens? What if inflation keeps moving on unabated and they have to raise rates 5 to 6 times in 1 year to try to combat it? Who knows? Stuff happens. It could be a long-term recession. You need to have a long-term mindset for this. On the other hand, it could just recover in 3 months, fall another 10%, recover in 3 months, and we'll be off to the races like in 2020. But you never know. That's the interesting thing about the stock market. That's why I always think, it's nice to have some cash on the side. It's nice to always have new money flowing into the markets, take advantage of these dips. If you have dividend paying stocks, they will pay dividends, hopefully, and you can reinvest them at lower prices as long as you have new money flowing into the market. If you have cash on the side, have an emergency fund in case you lose your job so you don't have to sell at an opportune time. You'll be fine in the long run. Do research. I probably have a couple percent of my portfolio in cash right now. Another probably 2 to 3% of my overall portfolio is in SPACs that haven't made a deal yet and haven't de-SPACed, so those are just as good as cash. I'll probably start selling some of those to buy some stocks soon, some stocks that are looking interesting soon. So I have plenty of dry powder here. Now, 80% of my money is in index funds, so those are just going to drop, and it is what it is. My portfolio on paper is suddenly looking a lot lower, and probably I'm losing, tens of $1,000 a day in these negative days, but it sort of is what it is. On the same front, I was gaining tens of thousands of dollars a day in a week, or in a week rather, when the stock market was soaring, and now it's the reverse, and I am okay with it. You have to have a mindset that says I'm investing for 5 to 10 years. And that's what you need to have to succeed in this market. Because if you start to panic and sell, and maybe selling some things is a good idea. If you look at some of your riskier names and those are down 50%, and then you look at some of these less risky names that actually have free cash flow already and those are down 50%, maybe sell some of those speculative stocks and buy some of these less speculative stocks. Maybe that's the play. I've done some of that. I've reallocated some money from my D-SPACs that are complete crap to some stocks that are actually free cash flow positive already. Now, luckily, I sold a lot of my D-SPACs before the $10 crash happened. For the most part, I haven't held anything beyond the D-SPAC range because the last couple of months have been just absolutely horrid for D-SPACs, and keeping them past D-SPAC has been just absolute craziness. I mentioned that on Twitter. If you follow me on Twitter, you'll know that. If you haven't, I've mentioned it in the last couple of videos that I did. It's just hard to keep anything past D-SPAC in the SPAC world. And a lot of other stocks have just become more attractively valued because they've fallen 80 to 90% and are looking pretty good right now. So that's really where the stock market is right now. It's an interesting time to be an investor, but if you're new to the game and you don't have a lot of money invested, this is going to give you a lot of opportunities to buy at a much more attractive valuation. And I think what's going to happen, if I had to make a guess, is that some of these high risk speculative names have already fallen 50 to 70 to 80% in the last couple of weeks, couple of months. And now if this continues, some of these less speculative names like even Microsoft and Apple and Amazon that have already been hit are probably going to be hit a bit more, and that's going to start making some of these valuations very interesting, and it's going to make for better investments. Because again, I'm investing for 7 to 10 years in the future, and if a stock market sell-off happens, then today's buys are going to be more worth it than the buys from a couple of weeks ago. That's just what you should keep in mind when you're investing today. Have a long-term mindset. If you're investing for the short term, there's going to be pain, and maybe that's not for you. You have to pick your battles wisely. You'll go on Twitter and you see these guys who are, hey, buy this, buy that. And it's very easy to make those calls when the stock market is doing well. It gets a lot harder to make those calls when the stock market is doing poorly. Puts are also an option, but the train has kind of sailed on that. In my mind, you can certainly still make money off of puts, but because of the volatility that's happened, the risk premium that you're paying for those puts is a lot higher than it was just a couple of weeks ago. So while I've made some money off of puts, I'm less in them right now. There's potentially some puts I'll be buying here and there, but for the most part, the stock market could turn on a dime and those puts could expire worthless. So I'm not putting a ton of money into those, but nibbles here and there, converting them into cash and just holding on or buying things, because in the long run, the stock market's going to go up again. And that's my thesis, and that's my investing style. I don't do a lot of shorting. I don't do a lot of puts. I do some when I think it makes sense. As some downside protection, I convert those into cash and just kind of buy things that I plan to go long on in the long run. So interesting market. Hopefully there'll be some interesting things to talk about. I'll probably do another portfolio update soon. And then we'll see where to go from there. Hopefully you're doing well. Let me know what you guys think about the market. But that's it for today. Just wanted to do a quick update, give you guys an update for what I'm doing. And hope your investing is going well. Hope you're weathering this storm well. And have a good day as always. This channel is just for entertainment purposes only. Make sure to talk to a qualified financial advisor before making any investment decisions. I am just doing this for fun. Thanks for watching and have a good rest of your day.